All right, are we live? We are live.
We're live in the show.
So none of this is trading advice. Of course, let's do the regular thing with anything
Right.
that you hear
On this YouTube channel.
Use your big noggin. We're not giving any advice. We're going to chat about some stuff. You talk to your advisor, do your homework, and nothing that we say is real. With that said,
for entertainment purposes only. Leverages and beverages.
I'm officially on the Dave Portnoy train, by the way. Is that the right first name?
Yes.
Who's the other Portnoy that you guys play?
Brian.
They're cousins, right?
They're related. No, they're not. Brian's gone to great painstaking effects to I don't know why.
From that.
Yeah, I'm not sure. I'm not sure if it's
I think his rules are amazing. Rule number 1 is stocks always go up, and rule number 2 is don't forget rule number 1. It's just
simple rules to live by.
I think this is great advice.
It's hard to back test looks good.
Here's my fearless prediction. You want to know my fearless prediction? He's going to go back to, and remember, this kind of follows in the conversation we had, Mike, yesterday with Steve that we're going to have on a podcast. But the moment that sports start back up and he closes his Barstool thing and starts betting on sports again, I actually think all the Robinhood guys go away and they have something else to play with. I'm going to mark the top. The moment we have like NBA goes live, that'll be the peak of the S&P. Fearless prediction.
Oh, nice. I like it.
By the way, I've been wrong. I've been 0 for 5.
Did you say the second we go with NBA goes live? What is that?
Well, yeah, that's the sports betting connection.
National Basketball Association.
National Basketball.
Yes. Okay. I see. Okay. So as soon as they go live, because of the sports betting, will be the distraction.
It's a popular sport, Adam. Yeah.
We always make fun of you for that, but that was fantastic.
It's a popular sport. Is that the one with the puck?
Close, Mike. Close.
Yep.
So what is our topic for today? What are we going to chat about? Sorry, I digress.
First of all, I'd like to thank everybody who keeps joining us for these conversations, which are, meant to be said in a happy hour setting. So yeah, as we've said, use your brains to extract any knowledge, and hopefully get lots of entertainment. And we do want to have the conversations that you might have, at the happy hour setting after a week's work, where there's lots of confusing rhetoric going around the investment world, and please subscribe and like and share the show. It'll help us gather more guests to have on, as well as our own personalities. And today it's beverages and leverages, or leverage over beverages, and risk and reward and vol trading of all sizing, and the implications for strategy, volatility, and all of that. And but I'm going to start with the beverage side. So I've selected a nice Chardonnay today, a Monfrère Chardonnay. It's from California. It's got a nice little elephant on a bicycle. I think that's fairly apropos for today's market. So that's my.
You elected to have a taste of Monfrère.
Exactly, precisely. Well played.
That's good.
I have the West Avenue cider today. Delicious heritage apple sour cherry cider, product of Ontario. It's very good.
Excellent. I'm drinking a vodka fruit punch because I have just in the last couple of days tried to kick sugar again, which I've been indulging in far too frequently over this quarantine. So I'm trying a sugar-free solution here tonight. So hopefully that'll go.
This is a Pinot. That has in Canada now. They show, if you go to the LCBO, for those who don't know, in Ontario we have a government-run liquor store that has all these bells and whistles. And in this case, you can actually look at the label for how many grams of sugar per liter. This one has 4, so you can drink away.
Outstanding.
And still be good, man.
4 grams per liter?
4 grams per liter. There's tons of those. Tons.
Wow. Okay.
You can drink a whole bottle of wine and still be
tons of liters.
Adam's the king. 25 divided by 4.
Tons of liters. They have extra liters at the store.
Yeah.
All right.
So
I
why are
think
we
this is,
inspired to talk about this today, right?
yeah, I
it's
think this is
because-
pretty interesting, actually.
I agree.
You've got a couple of, right. Go ahead.
No,
Set the
yeah, sorry
table.
to talk over you. Yeah, but so just I think it was this Monday, if not late last week, CalPERS, the California pension plan came out and stated that as a matter of policy, they're going to introduce about $80 billion worth of leverage on their investment portfolio, which I want to say represents about a 30%
20.
leverage ratio on the value of their portfolio. Was it 20?
20. Yeah. Well, that's what I saw from Twitter, but I could be wrong.
And there was all manner of reaction to this statement, and so it gave us an opportunity, a pretext to talk about one of our favorite topics. We've read a lot about this. You can't eat Sharpe ratio, and we talked a lot about the fact that the whole discussion of leverage is, as Mike will say, turtles. It's completely disingenuous because there's leverage everywhere. If you've got an equity portfolio, the leverage ratio in the S&P is 2-to-1. We all know that pensions and endowments have been leaning very heavily and at an accelerated rate into private investments like PE, private equity and real estate and infrastructure. All of these have a lot of leverage embedded in them. And so, now they're sort of making this explicit, but really nothing's changed. Now, I do think it's an interesting point of discussion about how they're going to use this leverage, whether they're going to use it wisely in order to enable them to further diversify their portfolio, or whether they're just introducing what we sometimes call a Texas hedge, where they're just sort of doubling down on that one primary risk premium, right? The equity risk premium that dominates most portfolios.
So I think I can provide a little bit of context that I don't think any of you have had, because I don't know if I shared this with anybody yesterday, but I was in a conversation with a CIO of a large pension plan here in Canada yesterday. I invited him to come, but he couldn't do it. He said he was zoomed out. And so we were discussing our strategies, how they would fit with his strategies, how they did during this first quarter. And he said, the alternative sleeve was absolutely decimated. ARP got destroyed in like a 12 vol ARP, didn't do what they expected it to do. Their risk parity portfolio lost over 20% at 10 vol. Their hedge fund portfolio, out of all the hedge fund managers that they hired, only one made positive returns. Everybody else lost money. And so he said, do you want me to know what we can do together? Absolutely nothing. Like, I cannot mention to the board anything that has to do with alternative. The word alternative is gone. The word risk is gone. So risk parity, risk premia, I just can't, it's not happening. And yet we are underfunded and we need to provide better returns. And so what I am leaning towards, I think the only tool left for me as a CIO is to use leverage on beta. And by beta, he means all the betas. And I said, okay, so you're taking a chapter out of CalPERS. And he's like, what's CalPERS doing? So independently, he came to the conclusion that all the stuff that was supposed to provide cushion and diversification and offset and excess returns has been dismal for the last 2 years. The board is tired of it. The only thing left that I can, because what he mentioned was, indeed, we know, when I mentioned the 2-to-1 on equities in terms of leverage and so on, he said, oh, I'm well aware. The board is well aware. That's why I can do that, because it is the easiest new thing that's old, right? That because they're already using leverage and I can be explicit about it. The only difference is that that's implicit leverage versus explicit leverage, that they're legitimately going to go out to banks and say, I need this much leverage in order to get more exposure, to capture that excess return that I need to provide for my constituents. So with that,
I mean, it's fine, but are they just talking about levering onto equity beta or equity beta proxies? Or are they talking
in their case, it's more like a 60-40. They're levering it a 60-40.
So then equity beta.
Yeah.
since 60/40
But
is
equity and bonds.
90%
That 60/40 will be. It's like what's that ETF that you can, Jake?
The 90/60?
The 90/60. It's something
Well,
like.
that's fine, but then they've got a larger capital allocation to bonds to even out the risk. It's not even, but it's better. Is that what they're doing? They're levering up the bonds?
That is what I took away from that. They're levering up both sides. He kept saying beta.
Well, if you preserve the 60/40 capital ratio, you're just leaving up equities.
Sure.
Like
Yeah,
it's
from a risk
complete
contribution.
nonsense.
Yeah.
Yeah.
Well, there's
again,
a couple of things I'd love to hear about
It's
too.
the only thing left.
Well, it's the only thing understandable that's left, and there's problems in there because the Sharpe ratio of that portfolio vacillates between 0.1 and 1 or 2. And so you lever that Sharpe ratio, and over 1, 2, 3 rolling periods, you're going to have vastly different outcomes. And then you get into decade-long periods where neither stocks nor bonds perform, and you have that levered. That's going to be a real sort of mess. But I kind of think this conversation actually triggered my thoughts because I haven't had a chance to connect with Adam yet on some of the things that you might have discussed with Andrew. I think it's sorry, Andrew. You just had a call with him.
Oh, Andrew Miller. Yeah. We did
with Andrew Miller on return assumptions, and then bringing that back to the research report from Research Affiliates that talked about the actual significant gap that the endowments have post-COVID on their pension requirements, on their distributions and whatnot. And so I would love to hear what you and Andrew sort of touched on. If you touched on that, I actually don't know because I haven't had a chance to listen to it yet. But those thoughts were things I wouldn't mind connecting.
I mean, Andrew had some really good points as usual. One of them was that non-recourse leverage is very different than recourse leverage. So, CalPERS is in a position to be able to issue debt. Now, I don't know whether that's true in terms of their corporate or the rules of CalPERS, but they could certainly modify the rules if it's not currently encoded in the rules to allow them to issue intermediate or long-term bonds, right? So you can issue debt, and that becomes non-recourse leverage, right? If you issue debt, 5-year debt, 10-year debt, then you can use that leverage to empower as a force multiplier on your diversified portfolio, because if markets drop, then the people that have loaned you money are not in a position
there's no margin call.
Exactly, there's no margin call,
and you're also locking in your interest rate too, as opposed
Absolutely.
to margin typically is obviously changing every night, so you get into variable interest rate risk, which is a whole other element of all of this. So interesting.
Yep. They obviously have different balance sheet components, right? There's a very large liability on the balance sheet, and so you can use the leverage to better manage that liability more directly as well. So there's a variety of moving parts, and if they do this properly, I think they should be lauded for it. If they do it improperly with just like a levered beta bet, then I think they're just all in on black.
Implicit in that too, though, is the fact that pension liabilities grow as the risk-free rate drops, right? So you've got this downward pressure on very long-term sort of rate assumptions, which actually sort of balloon the size of the pension obligation. And then you go to the market, all right, you're going to get some capital in. And then the assumption there has to be that capital has to be allocated across a various number of assets that will produce a return in excess of that capital and the payments, regardless of the margin call issue, right? Which gives you a longer time frame to have the vacillations back and forth, but you still do need to have an excess return. And if the equity risk premium disappears for a decade, that becomes still a challenging problem over a decade. I'm not sure how long they were thinking about issuing the bonds or what that might be like, but it still creates some interesting maybe unintended consequences or long-term consequences that are maybe more difficult to manage. It
just reduces the path dependencies in the short term, right? Like if they're able to issue bonds and create duration on their liabilities, then they're adding, obviously, I mean, their liabilities have fairly long duration anyways, but because they're pension liabilities, they're adding to that. But the alternative is you're borrowing using short-term borrowing instruments that are callable, which is a typical margin type borrowing situation, against long-term assets, right? So you've got this major duration mismatch. Like, take on debt, match your investments against the duration of that debt, and diversify so that, as you say, you're not vulnerable to a situation where you're levering up the balance sheet into a period where the growth side of that equation doesn't deliver enough returns to at least overcome the cost of borrowing, right? But I mean, the whole point is, if you borrow, it allows you, if you given a fixed return requirement, if you're allowed to borrow or introduce leverage, it allows you to diversify. Because when you look across the cross section of the available investments, stocks are high volatility and commodities are high volatility, but there are other types of investments that are much lower volatility. If you want to create diversification in the portfolio, you need to have some of those low volatility investments in there alongside the high volatility investments. And in order to hit your required return, you then have to lever up that full portfolio. So, it provides the option to diversify, but it doesn't necessarily mean that they're using it to diversify.
Correct. And even if you get into a long-term deflationary environment, even a minor one, you are having to pay back those loans that you took on a long-term basis with monies that are more valuable when you pay them back than they were when you took them out. If we're truly in a sort of pervasive disinflationary or sort of
and the value of your liabilities is declining anyways, because presumably the rates are going up and you've locked in a long-term rate, and your liabilities themselves are sensitive to the prevailing rates. So your asset liability ratio is improving in the case of inflation. And if you diversify properly, then you also have an opportunity to amplify that effect, because the assets in your portfolio that are designed to thrive during inflationary periods are producing excess returns. And then while the other sleeves of the portfolio are suffering.
Which answers the first question we got today, which is, how does managing leverage when both bonds and stocks are going down at the same time, right? So that's a great question, and I think you covered it. You don't. You're just more exposed to both of them going down at the same time, like in the 1970s. They were correlated, and they both returned around zero for the decade in real terms, right? So if you don't have an inflationary asset, whether it's tips or commodities or gold, and you're not levering the whole portfolio, then that becomes a problem. It becomes a real gap. So that's, I agreed. Levering up just the traditional 60-40 can be a dangerous thing.
Now, this has the potential to devolve into just another conversation about the merits of risk parity, right? So
why not? Wait. Why not? Okay.
Well,
so
it's not just risk parity. I think risk parity is just thinking through one lens of asset classes and the potential for asset classes to provide diversity to a portfolio. But that is not the only lens. There are the factor premia. There are things like carry, which even in a negative rate environment, you have carry. And so again, it's more about the maximization of diversification. If you're going to introduce leverage into a portfolio, it is very important that you are really providing some diversification to the portfolio that truly lets that portfolio thrive in any environment which you may encounter. And that's not just an asset class-based discussion. That's a factor-based discussion as well.
Yeah.
And I think one that is often overlooked.
Yeah, it's complicated because we use these terms interchangeably internally, right? Where risk parity is not just the traditional idea of diversify appropriately into stocks, bonds, and commodities. It is rather identify as many different sources of risk and return as possible, and then form a portfolio of all of those different sources of return in a way that allows each of those sources of return to express their unique personalities when the time is right. So so yes, and the idea is risk parity is much broader than what everybody seems to think it is, right?
Just
Which
gold
is
and
this
equities and commodities. So,
Yeah.
I want to address one thing that comes to mind now that I have, you see CalPERS talk about leverage as a pension plan, and they're kind of letting, when CalPERS does anything, all the other pension plans are like, oh, that's okay to do? Okay, well, I'll do it, right? And I thought this individual was echoing what CalPERS had said, but in fact, he came to the conclusion on his own. I wonder how many more CIOs of large pension plans are coming to the same conclusion and saying, look, the only thing left is leverage here. The question here is, there's a belief that there is a level of instability in the markets right now due to many things. One of which is this volatility targeting, like that the financial universe is actually levering up more than it ever has, and that this can lead to instability. Now that pension plans are doing it, how do we think about that?
Well, I'm not sure that that's what they're doing either, right? I mean, there's the idea of dynamic volatility targeting is different than the idea of creating a strategic asset allocation that you lever and rebalance, right? So they're two different things. Dynamic volatility targeting strategies are observing the current volatility environment. And since you're targeting a certain volatility, if the market volatility is high, you need to reduce exposure. And when the market volatility is low, you need to increase exposure. But that's obviously not the only way to use leverage or target volatility. You can target a very long-term volatility as long as you have strong assumptions about the true distribution of volatility on average over the long term. If you sort of say, well, equities have an average volatility of 18 or 20%, and bonds have an average volatility of 5%, and then you create a strategic portfolio that achieves that target over the very long term or is targeted to do so, you're not reacting to changes in market volatility other than perhaps to the extent it shifts your current strategic allocation out of whack, you'll then rebalance back to that strategic allocation. But that's actually counter-cyclical. The activity moves in the opposite direction from the dynamic risk or dynamic volatility targeting approach. So in fact, those two are nicely offsetting mechanisms that can preserve some kind of market equilibrium rather than exacerbating it as it so often can pervade or conveyed in podcasts and into literature. So
yeah, and I think that's exactly from what I've read, CalPERS is likely to do. It's going to set a leverage amount, and then when it goes below that, it's going to probably rebalance and re-up, right? And this is what, again, not to talk about risk parity again, but risk parity is divided into two camps: those that are dynamic volatility targeting, and those that set an amount of leverage and then are constantly acting as a counter-cyclical approach using leverage to stabilize the market, right?
Yeah.
So anyway, that's something that's come up quite a bit. Wanted to address it.
I thought it was interesting. I don't know if you guys actually had a chance to look at the research affiliates paper on this, but they sort of made the connection that in an environment where you've got a risk-free rate of 1%, call that the 1.15% on long dated treasury bonds, any return assumption over 4% is aggressive. The average state pension fund assumption is 6.5 with a large dispersion around it. So those are very large pools of capital that are faced with a pretty significant problem that I'm not sure that they're addressing. And CalPERS is going to add leverage. At the same time, they removed their tail protection, which is, if you were going to, I'm pretty sure, was it not CalPERS that decided?
Yeah, I think you're right. So they removed it like a few months before the event, right?
Right. So now you're going to lever into, well, we don't know exactly how they're going to be levering. So that is, I don't, at least, and if anyone has some comments out there that does know a little bit more detail, it'd be great. But it would seem to me that you might prioritize some sort of protection if you were going to lever in order to. One of those ways is obviously we discussed is diversification, right? So if you diversify, you are, cutting off the tails of the individual assets because of their exposure to the structural regimes that they have a proclivity to react under. And so that will smooth returns. You're also doing that through diversifying the portfolio. And there's a number of ways to do that. We talked about adding factors and whatnot, but it just seems strange that the reaction is let's throw the tail hedge out the window and now let's lever. It just seems quite reactionary. But I hadn't really considered the idea that they would be just issuing bonds into the marketplace, which is another interesting wrinkle in that whole thing. It allows you to take a much longer period of time to smooth out the returns.
Yeah, and I'm not sure that that's what they're doing, but I think that would be that's more akin to the Buffett method, right? I mean, I was wondering as we go through this, yeah, exactly. You've got sort of more permanent capital, right? I mean, AQR published, it was Lossy Peterson published a few years ago, a paper called Buffett's Alpha, where they decomposed Buffett's excess returns into factor exposures and access to very cheap non-recourse leverage through the float of his insurance company, and determined that Buffett ran his portfolio at an average leverage ratio of about 1.6. So I was wondering sort of what are they sort of trying to mimic the Buffett bet here with this leverage, or, just lever up into equities, or, they levered up into some other factor exposures. Buffett obviously preferred quality companies and low volatility, et cetera. Maybe they're taking some steps in that direction, which I think would be positive. But I wonder, the reality is there's a huge amount of leverage already on the balance sheet just by virtue of their allocations to equities, private equity, infrastructure, and alternatives, so you're in many respects sort of levering up an already highly levered portfolio. And if you're not taking steps to diversify away the concentrated risk in the portfolio, then you're probably compounding the problem rather than creating a force multiplier on the solution.
Well, what's interesting is that a large portion of the leverage, if not the highest portion of the leverage in a lot of these plans, happen to be private equity, private debt, right? And so one of the discussions we had yesterday with him was, I asked him, so, Canadians are really big into private equity. Canadian funds are big into private equity right now, hitting up to like 50% limits in the long-term portfolio. How is everybody feeling about that? And he's like, on the one hand, it's feeling good. It's dampened our volatility. There's something magical about that. On the other hand, the cockroaches are there and we don't have a clue. We're completely blind as to how much each individual private equity company is vulnerable to, how much leverage they have in the books, and we won't find out for 18 months to 2 years. So this is the kind of the trickle-down effect. But I think we all know, and he knew viscerally as well, that the leverage is a big problem there. And the only thing that's allowing them to deal with it is the fact that you don't have to mark to market. But it is
there's implied beta too, right? I know we know that we can model private equity returns with exposure to small value or increasingly, given the current size of the deals, mid-cap value companies. We know that small value has a beta 1.3, 1.4 to the market. So there's sort of this implied leverage anyways in terms of just the beta of the cyclicality of these companies to general market cyclicality. And then you layer on excess explicit leverage, and then you layer on, that the private equity companies themselves are layering on, and then you layer on further leverage in terms of you're borrowing to invest in private equity tranches. And that's a sort of negative or potentially highly fragile leverage that I think investors should be concerned about. And I mean, I'm not persuaded that that's not actually the direction that they've gone. And from your conversation with your contact, it does seem like that is the direction that these companies are going. It's just like, we're all in this together. We're all loaded up on equity beta. If equity beta fails us, we're all going down together, right? That we're going to go down spectacularly.
We're all going to from the government anyway, right?
We're going to be bailed out, which is sort of it's sort of kind of a couple of questions that we have here too. Is the incentive to lever up all asset classes? Okay, where does that end, right? So leverage in itself is a claim on future growth, and it has to either be paid back or restructured or debased. So so you have that issue, which I think, Adam, you're sort of alluding to, and also talking about the instability that it can create. So you've got more efficient, less volatile markets in the short term, but they are also subject to larger sort of single events, right? The instability creates this larger break point, and then the question of moral hazard is brought in. And for the long-term health, I'm not sure if that means the long-term health of the market. I'm assuming maybe it does, but I think that there's not only moral hazard from the standpoint of the idea of risk taking, so that you'll get everybody doing this until at some point you get a massive break. There is also the regulatory hazard, moral hazard, which is that of the central banks of the world becoming more and more powerful. These are not elected officials. These are not officials that come into the purview of being elected in a democratic format, yet they hold incredible amounts of power. And you see, you go from 2000, where the US had 15,000 banks, to today having 5,000 banks. That's a pretty significant contraction in the number of banks that can be operating in separately distinct marketplaces that can have some sort of diversity of their loan book and diversity of their opportunity.
Economic sensitivity. Mm-hmm.
Correct. And so this is this continued increase of potential instability. It's that castle of sand that you don't know which grain causes the potential sort of earthquake, or the potential actual realization of uncertainty, where you get the sort of the falling sand down the pile. But it's a weird situation, because as you say, leverage, all things equal, leverage creates instability. But to the extent that diversification creates robustness. Mm-hmm. So if leverage is used to increase diversification, there's this competing dynamic. It's interactive, right? So if you're taking on leverage in order to increase diversification, you're actually making the system more resilient. Then there comes a point where too much leverage makes it overcomes the value of diversification, right, and we begin to move back into a state of fragility. I don't think we're anywhere near just observing a typical pension portfolio or a typical client portfolio or endowment portfolio. I don't think we're anywhere near the point where, if there was a dedicated push to increase diversification, we would have too much leverage for the amount of diversification. The problem is we're increasing leverage without driving towards greater diversification. And so that increased leverage creates fragility. So I think there's this competing dynamic. Agreed. I think that helps answer the next question that's in the post. Go ahead.
Yeah, I'm just saying, like, I 100% agree with that. Some of the elements where people are looking to diversify, like we've talked about with private equity and some of these other investments, where the volatility is not as easily as expressed, maybe kind of low liquidity, low vol, not fairly representing the risk, but the risk is actually high. We've learned low vol often means high risk. And I love your comparison earlier of, strategic allocation offsets vol targeting, because vol targeting gets it wrong when vol's really low, and vol targeting gets it wrong when vol's really high. Generally, it's good. And the strategic rebalancing can do the opposite, so that they work. But I think you got to be careful when you diversify and leverage, being careful with regards to what you're trying to put in there. Don't fool yourself with some of the things you add into the mix. There may be a lot more leverage than you think.
And you can't. You're so right. I mean, you can't use volatility as a signal if they're obfuscating volatility, right? Like, clearly you have no sense of what the true volatility. I mean, we all know volatility is flawed anyway, but it's a whole order of magnitude more flawed when you're deliberately obfuscating the volatility by using private marks on whatever your investments are, like private equity does, right? Like, it's this strange open secret that private equity funds have low volatility because their marks are not priced by the market, they're priced by accountants. And
right.
the price
With a
that
smoothing
accountants put
effect.
on it changes more slowly than the discount rate that market participants use to price liquid assets. And
Yeah.
this seems to be a benefit that institutions especially really appreciate and adhere to. And it's like everyone's agreed that we're just not going to discuss the fact that they're deliberately obfuscating volatility.
Right.
Well, it's also what's interesting is how volatility is viewed in different asset classes by the general public, right? When you talk about leverage is viewed by the general public. So when you talk about leverage in the perspective of a portfolio, the first thing that comes to mind to most of the retail investors I talk to is, well, you can lose more than what you got. Like they're thinking you're going to use leverage to lever up small cap equities, which used to be quite a big thing in Canada with the mining companies when I got into business, right?
That's right.
Margin accounts were the thing, and everybody was levering up small cap equities, and indeed you could lose all of your money and more. And it is a real risk, right? So
most of those funds are not around anymore.
That's right. Well,
right? But
no, but I'm
were
talking about
billions
retail
of dollars
investors
in 2006, 2007, right?
But even the retail investors were listening to the portfolio managers' quarterly calls, saying what they were doing and what they were levering. They were going up to their broker with their margin accounts and levering to the hilts, right? So that is one way to view leverage. And now, because of what happened in 2008, Canadian investors are terrified of the word leverage, right? So there's this general leverage aversion. But as you mentioned, this is a different story when you're dealing with a well-diversified portfolio that when you're using leverage in order to increase diversification, right? You're not levering up a small cap equity. You're using leverage to maximize diversification. The other area that I always find interesting when I mention, look, we're going to grab a well-diversified portfolio and you can have it non-levered, and this is kind of the result you're going to get. If you use a little bit of leverage, you can get a better outcome for the same risk, right? This is kind of Nobel Prize winning capital market line type of stuff. And they're like, absolutely not. I'm totally against leverage. Okay, well, tell me about your home and the two other homes that you own. How much leverage do you have there, right? 20% money down, 80% leverage. Oh, well, that's totally acceptable. It's Canada. Toronto doesn't go down, right? It's totally acceptable for institutions to give massive amounts of leverage at a 5-to-1 ratio to individuals. The individuals are okay with taking it with perfect comfort. But the moment you talk about maybe adding a 20% leverage to a well-diversified portfolio, it's absolutely not going to happen. I can lose it all. Right? Mm-hmm. I just found that cognitive dissonance has always been fascinating to me. And you can talk about it with them and point it out, and they just still like, yeah, it's still different. So maybe what is the difference? What is it? Is it different? Is it that we're never going to
leverage, right? It's people don't notice. People are not constantly pricing their homes. So they're not thinking about their wealth in the context of this levered asset. So there's just no incentive for anybody to have risk aversion.
There's no incentive to call in the margins either, right? The margin calls for those, because then they abandon the property and it goes to shit. So they're like, oh, you can't pay? Sure, stay around. Let me know when you can pay again. Maybe there's some safety there, right?
I don't know. Maybe. I mean, in Canada, we haven't really, in like 30 years, we haven't had any sort of downturn in real estate. Even in 2008, there wasn't a meaningful down. It was kind of, it sort of flatlined for a year and then resumed its climb. So, I mean, as Canadians, we don't really know. And in other jurisdictions, I mean, obviously in Europe, you had all these borrowers in Eastern Europe who were borrowing in Swiss francs and euros who became very intimate with the risks of leverage, where the liabilities were rising profoundly because the currency that they borrowed in had been rising relative to their local currency at the same time as the value of their local asset had declined by a substantial amount. And so you've got sort of these double whammies, right? So I think if you were going to talk to somebody in Ukraine or some of these Eastern European states, that they would give you a very different impression of how to think about the borrowing for a home. So I think it's very
even I was with a private wealth individual, and he was lauding how he was very against leverage, and then I asked him what he's doing right now, and he's a deep value, small cap stock picker. And I stared at him, and I was like, "So you must understand the balance sheet of their particular companies." He's like, "Oh yeah, I get them. I'm fully involved." And how much leverage are they using? Well, it's different. It's balance sheet leverage, not the same thing, right? Again, hidden leverage skews the perception of the types of risks that you're taking, right? It's a
So
solid
Rod,
company. Yep.
I'm just thinking of like, okay, so you're absolutely right. 5-1, if not 10-1, is the norm. If not 20-1, in fact, is not the norm if you're first
Yep.
buying a home in Canada, and there is a comfort level with that. Let's go to a 5-1. I'm just imagining I'm a listener trying to figure out what could I do. You want to go 5-1. What do you invest in, and how do you most efficiently get that leverage? And I know the second one, there's a leverage is a tool, and the availability of the variety of tools varies dramatically, which we can touch on later. But what do you do with a 5-1? If you're going to leverage 5-1, does that change what we've already talked about at all? Or
it comes down to, we always talk about this left tail in equities, right? When you invest in the market, you have this left tail reality that, it's a 4 standard deviation event should happen once every 10,000 years, but it actually happens once every 5 to 10 years. That is true in a single asset class. It is a problem. If you're levered up and every 5 to 10 years, you're going to have a 4 standard deviation event, then you're toast. I mean, it's almost certain that you're going to lose all your money. So how do you do that better? Well, how do you reduce the tails? Well, you reduce the tails by having things that zig when the other ones zag. Let's look at 2020. So what happened to the average portfolio? I mean, the truth is that the vast majority of real money isn't 100% equities, right? Or 150% equities. They're in equities, and they're in a bunch of bonds and sovereign bonds, government bonds, German gilts, German bonds, Canadian government bonds, all made money while the market was going to shit. Gold was up, right? So when you include those asset classes, guess what happens? You start seeing a more normally distributed function. Those fat tails, actually, you don't see 4 standard deviation events. You can see 3 standard deviation events very rarely, but you're now hovering around 1 to 2 standard deviation events with a well-diversified portfolio. So now that that's kind of out of the way for the most part, you can now use thoughtful leverage in order to use that. Now, the question is, where can you get that leverage? How much were they charged? Like, I remember when we were part of a broker dealer, what was their margin rates? How much was the borrow cost? 8% or something like that back in 2000.
For what? For what particular?
Like a margin account in.
Oh, just 6% plus prime. 6 to 8% plus prime.
So, I mean, the problem is,
you can't overcome that. There's no risk premium.
There's nothing there, right? So the average individual can't say to his broker, "I'm like, listen to this guy's at Resolve."
Actually, I saw this advertisement on TV the other day, and Fidelity Schwab still charged 6%, and IB Interactive Brokers was talking about how they charge like 1.5 or whatever it is. Right. So there's your spread. It's in the current marketplace, I think it's around 5% for someone at one of the large broker dealers to try and employ any kind of retail leverage. It's not. It really is not worth the. It's really hard.
That's that even a thoughtful investor that listens to this conversation and says, "Okay, I mean, leverage is useful if I have a truly diversified portfolio. I'm going to talk to my broker and try to implement." It's a non-starter with that much VIG, right? So first of all, you have to go to other broker dealers that provide really institutional style borrow if you're going to try to lever up ETFs or equities or whatever. And that for going from a traditional broker to that requires a level of expertise, and the brokers that offer that are not easy to deal with as an individual, right? So that's it's doable, but it's tough.
Yep.
And then let's say that you do get there and you realize this is really good, but it's still expensive, right? Because I'm dealing with smaller account sizes, or maybe I'm just doing like cash borrow. Well, this is where I think what you were getting at, because I know that's your jam, Jason. Why don't you tell me about the efficiency of being able to use leverage on using futures contracts, right? What is so special about futures contracts? I mean, it almost seems like its primary function is to have
it's well, let me first start by saying I'm not recommending anyone go out and 5-to-1 and borrow to invest. I just was trying to entertain the idea. If you're going to do that, you're really going to think about diversifying, and you're really going to think about how are you going to get that borrow. And I think we hit on the point I wanted to get to, was that
Oh, really? Okay,
ability,
I had my banker on the line.
yeah, the ability to borrow, and borrowing is a tool, and it needs to be used wisely. But there are vast differences between John Public and a professional investor and an institutional investor. So certainly one of the tools we have available to us as a professional investor are futures contracts, which have implicit leverage built into them. And on a daily basis, every day, there's a clearing mechanism where we don't have counterparty risk. So that counterparty risk is cleared for us on a daily basis. So we have a great degree of comfort in our counterparty, which is a big risk if you take on if you borrow or lend large amounts of money to an individual, and you say, well, let's square up in a year. That creates bending and breaking in the system. But I won't get into all the nitty-gritty details, but certainly we've seen that the use of futures contracts used wisely can create tremendous opportunities from a borrowing cost standpoint. It's just less expensive to borrow. It gives ourselves access to effective borrowing rates and credit advantages in terms of low credit risk that are just generally not available. Even a smaller investor can use it, but they're dealing with you need size to deal with it properly, because futures contracts by
each contract is $50,000 to a couple $100,000 per contract, right? So
I always like to think of it as when you're buying gas, unleaded gas, you're not buying enough to fill your Honda Pilot. You're buying one train car full of gas.
Yeah,
so it's large chunks.
Yeah, you're not going to fill your car. You're going to fill your pool.
Right.
With gasoline, exactly. Yeah.
Didn't you do the calculations on that when we were having the storage issue at minus 37 crude? You figured out how much?
Yeah, I was contemplating draining my pool, draining the water out, and filling it with crude oil, being paid to put it in there. But there's a lot of other technicalities.
So there's the point on the questions. A well-diversified portfolio can only be constructed using historical returns. Adding leverage changes the distribution and invalidates the analysis in a dynamic system. Yeah, true. I mean, these are complex and adaptive systems, and but I do think there is a rhyme to the way history sort of repeats itself. There's a human behavioral proclivities that do lend themselves to performance chasing, to bias of recency, and that creates the herding aspect, and that herding aspect for humans is pretty deeply genetically rooted. And I think this is Mikey G. It's Michael G, but I'll nickname him Mikey G.
As a fellow Mike, you can take liberties with
liberties. He also mentions the fact that diversified portfolios leverage raise the correlation in the moment of the liquidity event, right? So sort of that mid-March period where you had liquidity across pretty much everything, and then you truly understand what is long vol and what is short vol. And even things that you might expect would be, trades that do well in short vol, like long treasuries, actually struggled with some liquidity requirements in that period. So you make some good points. I think there's
a clue there too, right? Yeah. There's a bit of a clue. So just going back to his idea of how a well-diversified portfolio can only be constructed in retrospect, I'm not sure that's quite true. Certainly there are elements to it that lean into history, but I think we can safely say that there are, that commodities and hard assets are fundamentally designed to thrive during inflationary episodes, that stocks are fundamentally designed to do well in a growth environment, that bonds are fundamentally designed to do well during deflationary episodes. There are elements to diversification. I mean, if you want to take it to extremes, a put option is structurally designed to be negatively correlated to whatever the underlying it's hedging. So
designed to deal with inflationary periods.
Yep.
So I think
some good conversation.
like if you wanted to take it to the limits, which is I think what Mike was saying. So what he's talking about is correlation risk, right? So these things are non-correlated until they all are correlated. There's a risk there for sure. And the question is, how long is that risk? When does it happen? And I think it happens at liquidity events when there's a complete okay, let's just take all the bets off the table and go to cash. And we saw that in March. We see it every time there's a major market. There's like a momentary period where the rug's been pulled out from under you. And that's when the Fed steps in and makes sure that the markets are working and functioning correctly. And the moment that they step back in and add that oil to the gears, all of a sudden the diversification comes back online. But there is that gap risk. And the more levered you are, the bigger the gap. I would venture to say that let me finish my thoughts.
Okay, sorry, you can finish.
That gap could possibly be filled by what, the most loved and hated option, which is that tail protection, right? That thing that's there when, let's say, we gap down, everything correlates all of a sudden for 3 days down, volatility spikes, a long vol strategy can mitigate a lot of the issues with with whatever lever position you want to be in. Right.
Totally. And I think this is where it gets hard. This is where we're quite systematic in our thinking and it becomes more art. And I think, Adam, you've got a great story of 2008 where you pinpointed the epicenter of the European banks as being, the closest to the actual epicenter of the tectonic event, if you will. Mm-hmm. And maybe you can share some stories around that because it's really hard to do that. Even when you
and it requires a different way of, there are ways absolutely using network topology, and there's quantitative ways to identify cluster centers or where risk centers. And so this is absolutely a very interesting area to explore. And there's some really good sort of war stories from 2008. And I'm certainly happy to go there. I did want to talk about, because I didn't mention sort of this clue, and Michael G mentioned the idea that when you add leverage, even in the presence of strong diversification, that when more market participants are leaning into leverage, eventually the leverage itself becomes the systemic risk, right? And so I think that's a really interesting statement. I think there's a clue there, because it's not like it's impossible for systematic managers to measure to a reasonable approximation the total aggregate leverage in the system. And so is there a feedback mechanism that systematic managers can use that allows them to look at their target leverage relative to aggregate leverage in the system and say, great, there's not much leverage in the system. My systems say that I should be more levered. I'm going to add leverage. But when my systems say that I want to be more levered, but there's a high level of aggregate leverage in the system, then you begin to reduce leverage. And in that way, your adaptive system becomes adaptive to the markets adapting. And I think it's an extra layer of thinking that again sort of validates or provides a way to see how even systematic strategies can adapt to markets that are simultaneously adapting. Right?
It's insanely reflexive. It's insanely reflexive. The moment that, Mike actually just asked another great question. That's an assumption, and the growth of systematic strategies designed to offset those biases changes those assumptions. He's right? You have this perpetuating system creating a popular trade. But there are ways to, we've identified it, there are ways to identify that there's a bias. And how do you make sure that you use quantitative methods to identify the bias and not participate in the bias?
There's a difference, because I think, and Michael, you can clarify, and maybe we'll have you on.
Maybe we'll bring you on
a future discussion. But if you are moderating your leverage by instead taking on tail risk strategies. So you've identified you've got risk, you've got high levels of leverage. Therefore, I'm going to buy tail hedges. There's two ways to reduce the risk. Maybe there's more, but let's talk about two. One is reduce exposure. Another is keep your exposure and layer on more exposure, right? So you're gonna introduce a tail hedge.
On the other side, yeah.
You're gonna, but that tail hedge comes by introducing more exposure. If you're managing your tails or managing your exposure in response to the identification of the fact that there's lots of leverage risk in the system, you're adding to the leverage risk. If you are reducing exposure, you are not. So I do think that Michael G has a point, but I do, there's two ways to think about it. And one way reduces aggregate risk and one way changes the nature of aggregate risk, but probably doesn't reduce it. And in many instances may actually exacerbate it.
My guess is that Michael would rather not have any leverage in the system. I'm not sure he's a tail hedge guy. Like the way to deal with this risk is to, you're going to reduce your exposure, maybe have no leverage from an explicit perspective. You still have the leverage embedded in the asset classes that you invest in. Hopefully you're diversified. And you will still have, at the level of risk that you have decided to participate in, you will have more gappier exposures than you have in the past, if indeed this is true. It is a reality of the markets. And the question is, do we want to give up? Or do you want to say, okay, that's the new reality. Let's try to be reflexive of it and solve it. Understand the nature of the market and do something creative with it.
I think
it's always been this way.
Yeah, and there's another point of in his initial comment, well-diversified portfolio. Is there a way to identify how many actual bets you might have in a portfolio? Because those are dynamic as well, and how sturdy are they? How rugged are they to actually be supportive? Are they structural in nature? Are they potentially vulnerable to that sort of liquidity event? Where so for gold's a great example. So you think that gold provides this opportunity for a different asset class, but in March it really doesn't. The same. I mean, even a better example would be treasuries. You think that that's going to be there, and there was actually some liquidity issues in U.S. treasuries and notes. So it's an interesting.
It's true, and thinking about bets, as you say, right? There's a number of different lenses through which you can think about the number of independent bets in the portfolio, and if you just use the contemporaneous correlation estimates to calculate bets, then you're making some strong assumptions, right? And so if you're going to think about how truly diversified your portfolio is, then you need to create scenarios given your current portfolio weights. Let's create some scenarios where the correlation structure is highly punitive to your current exposures, right? Now, how many bets do you have in the portfolio, and what is the implied vol? And if you're simply running your exposure based on some kind of contemporaneous volatility estimate without introducing some scenarios or some shock estimates, then you run the potential to be very highly exposed by overestimating the number of bets in the portfolio at exactly the wrong time.
Well, and Mike has a follow-up point. Sort of, however, when leverage is used to generate return rather than facilitate capital formation, it becomes a systemic risk. Well, it depends. Is it pro-cyclical or is it counter-cyclical to your particular portfolio? If it is a tail hedge protection or some sort of counter-cyclical event in your portfolio, I'm not sure that actually becomes a systemic risk. It's like a short seller. What do short sellers do? Well, a short seller actually stabilizes the market, because when you have a decline in the market, those short sales need to be covered, and it reduces the drop because those sales that were made by, call it sharp money, smart money at the top, have to rebuy, and they will be a stabilizing force in the market. So I'm not sure.
I also think that the idea of capital formation is, so you get capital formation when your expected return on investment is higher than your weighted average cost of capital. So there's a lot of estimates in there, right? And
you can be
like
levered
I said,
into a company that's just losing money.
Absolutely,
there's no capital formation there.
Absolutely, and obviously, if investors and corporate managers are acting rationally, then they're not taking on debt in order to facilitate investments in projects that have negative expected value, right, after accounting for the cost of capital. So, I mean, in a properly functioning economy, managers are deploying capital in order to create capital formation. But
it's many wheels in the machine, right? Going like they're all. We love to kind of create narratives around it's this and that, but the truth is that to to make a bank seem like them giving leverage for the sake of leverage to a portfolio manager that's just trying to get excess returns. Well, what's the bank's role there, right? The bank's is going to have a P&L there. And the better they do there, the better they manage the amount of leverage that they provide, they're going to get a fee for that. That fee is going to go into their base. And that is going to help them finance good companies by lending to those real companies. It's all a vicious circle. It's all part of, are you managing the leverage in your portfolio as a bank well? Are you doing the right thing? And if you are, you're increasing your base. And if you're increasing your base, you're able to lend more to other companies. And you wouldn't have that benefit if you hadn't, gotten that extra juice from securities lending, right? So it's all part of it. You
can only measure that in retrospect, right? You can only measure what the optimal leverage ratio is on the corporate balance sheet or on the bank balance sheet or in your portfolio ex post, once you've actually realized the return on capital. And until then, it's an estimate. So you don't know if your activity is facilitating capital formation in advance. You only know that in retrospect, right? And when, of course, you've got actors in the market that are creating distortions in the cost of capital, then how do you even think about capital formation? Yeah, exactly. Yeah.
Actually, this comes back to a point that Jason made earlier about exchange listed types of futures where you have some certainty. Where if you were counterparty to a swap with Lehman, you had a problem. If you were counterparty to a exchange listed futures contract, you had a much higher level of certainty. And I think that layers into another point that I think, Jason, you've got a ton of experience in this, and that's the different types of leverage, or notionally, right? There's a NAV leverage. So there's a leverage on your NAV, but then there's in the world of futures, there's a margin utilization approach, which, because, having leverage of 200 or 300% NAV leverage with a Eurodollar contract is very different than the actual margin equity usage in the futures world. And I don't know if you want to take a poke at sort of enlightening people on that, Jason, at all, or if you.
No. They're kind of related. The margin to equity relates to the volatility of the contract and the size of the leverage of the contract, the notional value of the contract relative to how much margin you have to put up does vary. And that actually, I look at that as the margin requirement as an uncertainty that never really works for you. So in the time of stress, crude oil contract margin skyrockets. When everyone's piling into VIX when volatility is low, their brokers are asking for 4 times notional. So it is actually there in a way to really it is there to protect the system. So there are a few things in place, again, for larger investors or professionals or institutions where we can have access to properly use these contracts. I'm not sure if that
let's remember what futures are for, right? They're very useful for producers. They're very useful for the economy. They're very useful for companies.
Oh, absolutely.
The less financial participants there are, the less liquidity they have in order to hedge out those risks. So reducing the cost to hedge is important. It's part of the work. Now, on average, that is a fantastic, useful tool. Do we get out of whack? Of course we do, right? This is a dynamic system, and we can get too many speculators and too little hedgers, too many hedgers and too little speculators, and it's never a straight line. We can continue to try and create regulation in order to minimize the variance there, but it's in the
commodity. Sorry, go ahead, Mike.
No, you guys keep going.
I was just going to say, in the commodity markets too, it's important to understand, like in the height of the of 2008, which I lived through, and the liquidity just vanished everywhere. But there's a lot of markets where liquidity was extremely rich. For coffee, for example, people still needed it, so the roasters needed to buy it. Starbucks was buying it. The growers were selling it. There was this rich market outside of speculators and hedgers. Of course, speculators and hedgers add a lot of liquidity at the margin, but to have that extra element there of liquidity is huge, and also even things like. I remember on-the-run bonds or bonds, period. The only thing that had liquidity was the precise on-the-run bond for the 10-year and the 5-year. Even in governments, around the edges, you'd lose liquidity. And if you've got recourse loans and you got a slightly off-the-run bond and it's marked at a wacky price in combination with other stuff, then all kinds of things happen. I guess the lesson is leverage turns up the volume, and if you start getting static, it becomes more and more uncomfortable. So you just need to be, obviously, just need to be balanced, responsible, find that place that makes sense.
We'll always see in periods of duress those who took on too much leverage. And we'll also, I wonder how many of these people care. Maybe they were just like, that's my risk tolerance. I knew it was going to get blown up. Maybe they didn't think that it was going to get blown up. But in the marketplace, there are always people who are risk seeking and people who are risk averse. And there's people in the middle who, with the right amount of leverage, cruise through. Not a big deal, right? So there are other excesses, absolutely. Are we seeing a system that is levering up just generally, where governments are levering up, and we're seeing an increase of that? For sure we are, right? For sure. What's then the dynamics from inflation come in, and how are we going to deal with that leverage? Are we going to reduce it and actually crush the economy, or are we going to start inflating as much as we can in order to reduce our debts over time? At which point, what are the likely asset classes that are going to benefit from that? Like commodities and gold and the like, that provide an offset to an economy that's in high inflation, right? So again, it's just a living, breathing thing. And excesses come and they go. And they came in at the end of 2007, and they went by the bottom of 2009. We might be finding a similar situation in the next decade or so, right? If you're thoughtful about managing risk, then that's what you get paid for if you're an active manager, right? And if you're not an active manager, then being thoughtful about not levering up is probably a good idea. It's just,
so where do we want to land on this thing, right? I mean, I think where I land on it is if CalPERS is adding leverage to be able to hedge off risks that they currently are not hedging, while not having to lower their expected portfolio return, I'm a hell yeah. If they're going to use this leverage to buy some combination of tips, commodities, gold, other asset classes that are going to hedge their against
exposure
risk, which is in an amount that's appropriate given their liabilities as well, which actually have that complicates their exposure to inflation in a way that a lot of investors don't have that kind of complication. But if they're using it for that, then I think I'm a hell yeah on that. If they're just using it in order to increase their expected return on their concentrated equity oriented portfolio, then I'm a hell no. And I think that does in aggregate increase systemic risk. It increases the risk to the institution, and it increases the risk to the economy, and makes the entire economy more pro-cyclical. So
like anything in life, right?
Right. The pensioners are going to experience a reduction in their benefits if that goes wrong. That has happened. All right. In Nova Scotia, we have had that happen in Canada, where across the board, pensioners experienced an across the board reduction in their benefits, and it had to be restructured. So that is not new. And at some point,
but it's politically intractable, right? I mean, look, what's the root of this? The root of this is the absurdity of a 6.5% expected return with treasuries at 0.5%, right? I mean, that's the elephant in the room we didn't even address.
Correct.
Insane PE valuations and all that fun stuff, right?
The expected premium is 3 times higher than is probable. So, that's the major problem. And so you could either tell your stakeholders, your board of directors and indirectly the pensioners that are relying on this future stream of income that CalPERS is going to purport to produce, that they need to reduce their expectations about what the income that is going to be produced from this portfolio, or the state is going to have to raise taxes in order to make these pensions whole, or some other gap needs to be filled, or you carry on this facade, this circus, right? That we're just going to lever up in order to be able to make our return targets. What everybody knows, I'm sure all of the internal discussions in the CIO office at CalPERS are all, listen, guys, I know we're never going to make these returns, but we've got to make a show of it because our political stakeholders require it, and the public will not tolerate any of the other options that are available to us.
So I think in close, I think you asked what do we want the takeaway to be. I think the takeaway, like always, is it's we like to paint these things as one or the other, right? But the truth is that it is all gray. Is this a tool that is good or bad? It's neither. It can be really, really good. It can be really, really bad.
So it's both?
It is, depending on the person, depending on how you're implementing it, right? This is, are you gonna use
I'm just saying it's both, it's not neither.
Yeah,
I know. Sorry, I was thinking.
No, it's proving it.
I know English is a second language. I'm sorry.
Put it in front of the thousands of live listeners right now. So we're being asked if we were all supposed to wear blue today. Yeah, we were all supposed to wear blue, and Jason didn't get the memo.
No, that's dark blue. He can't tell. That's dark.
It's true. That's true.
There is no black in actual fact in the color.
By the way, I want to shout out to Michael Green, who clearly was responsible for sparking a lot of the directions we went in this discussion. And Mike, you're front and center in terms of someone who's targeted to be on this show. So
yeah,
we got some guests scheduled for the next couple of weeks, but we're going to have you on sometime in July if you're available. We'd love that. So please continue chiming in and prompting hard points of discussion in the meantime. Appreciate it.
Yeah.
So we had Corey poking and prodding last week and Mike this week, and we're really grateful for the people that are making our life difficult.
Fantastic. Well, it makes for good discussion.
Totally. Absolutely. 100%. Yes.
This is not about having an easy discussion. This is the discussion that is had over happy hour in places of financial centers where you sit and talk at the end of the week about very difficult topics and how are we going to handle it? What are the changing dynamics? I mean, Mike Green has had a spectacular insight into the changing dynamics of markets driven by passive investing. And there's some great counterpoints out there to that. And so we revel in the hard discussions because that's where the opportunity for advancement for all of us is.
Exactly.
And so I think that
I actually have restrained myself from talking about risk parity and the blame that it gets in all this. I have the article up that I have everything in place, but I actually want to save that for Mike. See how why he just keeps on saying it's all about risk parities and vol targeting. We'll get you on, Mikey. And I think next week, though, we have, unlike normal riffs, we do have a set topic for next week, right? Is that
right? We're going to talk a little bit about Bitcoin. We have a pretty
crypto in general, right?
Crypto in general, and in Canada has been very much like Robinhood's taking the blame right now. It's true. There's been some stories that are very sad in Robinhood too about some traders that have had some pretty significant outcomes on the negative side that have caused some angst. But getting back to the point, Canada was the first to evolve and develop an ETF, an exchange traded fund. Canada's also been on the leading edge of developing an exchange traded closed end fund for a Bitcoin trust. And our head of futures trading moved on from our firm from Resolve to 3IQ to develop that product. So we're going to have him on next week, and we're going to talk about crypto. Is it the new digital gold? How is it impacted in the digital economy? Very interesting topic. You have people like Paul Tudor Jones talking about a 1% allocation being a very smart allocation. If it goes wrong, you're not hurt too much. But if it is the next coming, then you have an exposure that could have some significant impact in your portfolio. So we want to talk about all of the good, the bad, and the ugly with respect to that. And Sean has been instrumental in architecting a product that is traded on exchange. It's prospectus based, so it can be offered to the broad public. And so this is a very interesting topic. And I will also say that Andrew Miller's podcast that we were talking about today will be live shortly too. So we talked about that earlier today. That's going to be live on the Resolve site. And I think there's some interesting.
That was excellent, by the way. Yeah, as usual, Andrew, just tremendous insight. We covered, a dozen different topics, all of which I think are timely and relevant, and where Andrew had a very divergent opinion, I think, from common views. So highly recommend people tune into that. Probably dropping sometime early next week.
Share, and subscribe. Hit that little bell so you don't miss a single episode.
I'm glad you're responsible for saying that.
I also think, hey, topics we missed today. I wanted to talk about our experience with China and how China has been trying to get more speculators into their futures market in order to make the efficiency of that market. That was a topic that I think listeners would be very keen to hear about. I don't know,
We've got people that we can bring into that conversation who would be able to add a lot of color to that, and I think who would be great guests. That's a really good point.
Okay.
So I think that's something interesting for down the road.
Yep.
All right, gents. Getting this thing
All
cut,
right.
family.
Thanks
Enjoy
everyone
the
tuned in
weekend.
and asked questions and engaged. That was great. Thanks, guys.
Thanks all.
All right. Cheers.
Enjoy the weekend.